Any dark?
There we go. Maggie, can you hear us clearly?
Yep, now I can.
We're going to mute it for just a few minutes. We're going to give people a few minutes to show up, everyone. Yeah. Hello, everyone at home. We're going to start in about 2 minutes. What we'll do is, if you have questions along the way, I think that the group's small enough where I'm happy to answer them. Occasionally, I'll say, look, let me answer that in a few minutes because it's going to be part of the speech. But I do love answering questions, so I'm happy to take them as we go. Let's see. Told you we'll be ready in about 2 minutes here. What else? That's it. That's it. Bless you. All right, we're gonna go ahead and get started. And so I've got some of my accountants with me here today. I shouldn't be speaking to them. You guys are gonna see my back, but go ahead and if you have questions along the way, just go ahead and unmute yourself and speak up. I'm happy to answer them as I said before.
Yeah, I think it's just stand like right there. They'll be able to hear you clearly and they just won't be able to see it.
Good luck getting me to stand still.
You can sway over on this side.
So, we've been, my mother started this company, for those of you who don't notice, my mother started this company 54 years ago. I've been running it for the last 15 years or so. And, all that to say, we're not here to do the hard sell. We've been in business for a long time, but we specialize in realtors. And so as you know, a way to give back to the real estate community, we love to go out, give speeches, educate you folks. And if you find that, you know, we're a good fit for you, or your current accountants aren't doing some of the things that we can offer, then maybe it's time to come on board. For the most part, we don't take clients anymore unless they're real estate professionals. Because we've been around so long that we used to have a broad scope of tax returns we do, and now it's just real estate professionals and real estate investors. And that's about it. You know, if you're selling to somebody and, you know, they're going to be itemizing for the first time, we're happy to do their return. After the first time or two, they're not going to see the value in paying our fees because there's not that much we can do for them. But a lot of times when people are purchasing their first house, they are, you know, they're very scared about doing their tax return. So we're happy to help out those people. They don't tend to stick around. Realtors stick with us forever, as do real estate investors. So we love you folks, and you know, nothing is meant to be the hard sell today. Although the good news is, for the first time in a few years, I've actually been able to hire some accountants this year. So we do have, for the first time, a little bit of capacity. And so we're not, you know, my rule of thumb for the last 3 or 4 years, ever since the pandemic started, was if we were bringing on a new client, we were basically firing 2 clients to bring that person on board. We're kind of not in that situation anymore. I do have a little bit more capacity, but we're not dying for clients either. If that makes any sense. All right, so let's see here. Will this work? Nope. Do it live. Do it live. There we go. And so I'm Preston, by the way. I'm an enrolled agent, and we like to start off with this little quote from Albert Einstein. The hardest thing in the world to understand is the income tax. And that stems from when he emigrated to the United States, and he was working at Princeton. Back then, the IRS, and some of us in the room are old enough, I'm even old enough to remember, the IRS used to send you a blank tax return in the mail that you could fill in with pen and paper and send it back to them. So he got his, and he spent a couple of weeks trying to figure it out. And the tax returns back then were 10 times easier than now. But couldn't figure it out, sent it back to the IRS with a note saying, you all figure this out. IRS doesn't offer that service, and he ended up having to work with a tax professional over the years. And this was something he had told his tax professional. So let's see here. Now, we all know that Albert Einstein was a genius. He's smarter than any one of us. But the reason we relay that story is we want you to understand, you folks are real estate professionals. He was a physicist. You're not tax professionals. Do not give tax advice to your clients. We don't want you folks getting sued. We are a resource, you know, as specialists in real estate, and we've done a lot of other issues. We've handled tons of other issues, so we can answer client questions. And in this way, you folks aren't getting sued. So if your client has, and usually your clients are going to have some sort of question relating to their real estate transaction. We're great for that. But tax professional, whether it's us or whether it's somebody else, make sure that you're not giving tax advice to your clients, because we don't want you to get sued. Because what is the answer to every single tax question? And this is also, you know, when I was going to law school, at some point, first year, somebody raises their hand and says, so what's the answer? It's like, whatever you can argue. And with, with taxes, what's the answer to any tax question? It depends. We need to understand the entire tax situation that a client has had in the past, what's going on right now, and what they're looking to do with themselves in the future before we can answer any question. We need to look at last year's tax returns. We need, so, you know, you can't just go out as a real estate professional who's, you know, taken some classes having to do with taxes and real estate and be giving tax advice to your clients. Don't do it. You do, especially if you're selling, you know, if you're getting involved in 1031 exchanges, if you're getting involved in investment properties, you don't want to be giving any advice on those situations because you're probably going to be wrong. And a lot of times, somebody will call me up and I'll say, look, generally, I think this would be the answer, but I want to take a look over. And once we start digging into their tax situation, we realized what we thought would be the answer right off the bat was the completely wrong advice. And so, you know, they're either going to owe way more in taxes or way less in taxes. But without delving in, we really can't figure that out. And sometimes it's easy. Sometimes it's just a half-hour consultation. You know, but do not give tax advice to your clients, please.
Quick comment, like the biggest tax question, I think clients ask real estate agents, or we tell them something that Google is, you know, if you lived there 2 of the last 5 years, you can claim it as a primary, and you get the tax free up to 500,000. But that's like the biggest question that clients, I always broach this up with clients, and then I tell them to Google it.
Right.
So I'm a realtor, not a tax guy.
Yeah.
That's like the biggest question, I think, for my tax real estate clients.
Yeah, and we can, and a lot of times I can give them an even better answer than that, which is, and that is going to come up a lot, and that's very important, exclusion. And there's exceptions to it as well. So it can be 1 out of the last 5 years. So, you know, having a tax professional look at the situation, but, you know, you definitely don't want to give them any sort of hard and fast answer. But a lot of times, you know, you look at that exclusion and say, they purchased the house for $100,000 and then they're selling it for $1 million. Okay, so they're going to pay taxes on $400,000, right? Well, no, they put $100,000 into their kitchen, they put $100,000. So we need to establish that basis and figure out. So oftentimes we can give them an even better answer that's going to make them even happier than, hey, you know, you're not going to have to pay taxes on $500,000. Well, they may not have to pay taxes on a lot larger amount than that. And oftentimes with a personal residence, it's rare that we end up having to pay any capital gains on a personal residence at the end of the day, even with people selling their houses at 1.3 million or so, because we can go back and recreate how much money was spent on this house over the last 40 years. And sometimes the answer is, hey, it's a tear down and it's filled with tax and no money was spent. Well, okay, and you sold it for $1 million, and at the end of the day, you got a $100,000 tax bill. You know, stop crying. But more often than not, we can get them out of having to pay any taxes completely legally, because there is also, you know, costs involved in bringing the house to market, costs involved in when they purchase the house as well, above and beyond the original purchase price. So.
I mean, just to keep talking about this, but just like if clients go, well, I'm thinking about renting.
Thinking about renting the house?
Yeah, but they lived in, they occupied it. Well, that's good. Like, you probably might be okay in the long run, but look into the.
Right. And so
bring it up to make contact, you know.
they definitely want to talk to somebody, because a lot of times I've had that conversation 2 or 3 times in the last year with potential clients or doing consultations. And, you know, they've had the house for 30 or 40 years. And I'm like, you know what? First of all, we're going to be depreciating the house. So there probably will be some sort of tax bill at the end of the day. If we lose it, and, you know, we don't want to risk the exclusion, especially as we're getting close to that, you know, eating up 3 of the 5 years when they're renting it. And so sometimes it's better to sell the house, buy themselves another house. So they've already not paid taxes on the situation, and they buy a small one. But it's what are we trying to accomplish? You know, and so that's the conversation we need to have with the client. So I would think that this is relevant to all of you because it's pretty big around here with, you know, people living in their house for 30 years or so, and the houses are, you know, have appreciated, even in the last 10 years, houses appreciated significantly. So there's lots of considerations when you go to sell a house that has appreciated that much. And sometimes it's better to just, let's sell it, lock it in, and then do two. And that's great for the realtor, because now we have 3 transactions, right? If it's all local, but we're not only selling the house, we're helping you guys, you know, get the listing to sell the house, but then they've got to purchase another house and a rental property. Yeah. So just something to be aware of. But once again, don't give tax advice. Let us do it. You don't have to use us. You can use another tax professional, but just don't get yourself in trouble. So here's a couple changes that are recent. And I like to spend way too much time on these, but I'll try and go through them real quick here. You've all heard on the news, depending on the news station that you listen to, that the IRS is hiring 87,000 people to help out taxpayers or to audit taxpayers. And the answer is it's a little column A and a little column B. For about 3 years, I was not able to get anybody from the IRS on the phone at all. And if I had to do anything by mail, it was taking 1.5 to 2 years to resolve any issues. So I've noticed in the last 8 months or so that the IRS has started to pick up the phone. They do have more people who are there to assist us, but because they're newbies, you know, about 30% of the time am I able to actually get an individual on the phone and resolve the issue. But at least we can get the ball rolling over the phone and doing some, you know, faxing stuff back and forth or uploading them documents, things like that. We've seen, in the last 10 years, we've probably seen 3 audits. We have 2,000 clients, and 2 of them were in the last 3 years or so. In both cases, they were people that we had told them for years in advance, you're doing this wrong. If you were audited, you won't pay any more in taxes, but there's a very good chance you do get audited. Both of those 2 people got audited. And in both cases, they said there's more audits coming down the pipe. Because they were even bringing trainees in to, in both cases, no change audit, thankfully. But you know, the last one of those was about a year ago, and we really haven't seen any more. So I don't really know if they're going to be auditing people. A lot of our clients are we file pretty bulletproof tax returns, and if you know, if a client has a good chance they're going to be audited, we go through that with them and say, look, if I was an IRS agent, I would probably audit your tax return. Here's why. Make sure you have all the documentation on this. And when that does come down, there's no surprises, and usually it's a no change audit. So we haven't seen any surprises in audits. We did 10 years ago, back in 2011, there was tons of audits, but we're not seeing anything like that. So good news is, with all of this inflation, we've got the biggest jump in tax brackets the last couple of years here. And what that means is if you made the same amount of money this year as you did the year before, then you're actually going to pay a little bit less in taxes. So that's all that means. For years, we didn't have much inflation, so the tax brackets weren't moving. The numbers for the tax brackets to get into those tax brackets weren't moving very much. Now we're seeing $5,000, $10,000, $15,000 jumps in where it takes to get into the next tax bracket. So let's see here. We've got the, oh goodness, the FinCEN reporting. I'm going to come back to this at the end because I'm sure I'm going to get a lot of questions about this. But just know, for those of you playing the home game as well, if you have an LLC, a partnership, an S Corp, you need to look into what's called beneficial ownership information reporting. As tax accountants, we've all called our insurance companies, and they will not let us do this. It's very easy to do, and I'll talk about it a little bit more. But if you own, you know, you can zone out now, but later on when I talk about this at the end, because I know I'm going to get a lot of questions and up here. I just sent out a, maybe, did you get my newsletter? Yeah. I just sent out a newsletter to 5,000 people, trying to explain this without giving legal advice. And in 24 hours, I had about 10 responses. Person said, oh, I don't have to do this because of this, or I do have to do it. Every single person who thought that, thought they had come up with the answer for them was completely wrong as to whether they had to do it or not do it. And I'm not allowed to get, as an accountant, I went to law school, I'm not a bar attorney. I know enough to know I can't give legal advice on this. I'm probably going to get each one of those people who responded to me on the phone individually and say, look, you got it wrong, and this is why. Because I don't want, the penalties are huge on this. I'll come back to it. All right, we have the energy efficient home improvement credit. Don't do home improvements just for the credit. To tell your clients the same, but there are some good credits for certain things. Some things are limited to a $600 credit. Other things are limited to $2,000. I think heat pumps. A regular heat pump, you can get up to like $2,000 in credits for that. Windows, doors, things like that tend to be about $600 credit. So, you figure if you do some windows and they cost you $2,000, what it actually costs you, well, you're getting that money back in taxes. It only costs you $1,400. I was looking at getting the hot water heater. Is the hot water heater? I think it's $600 for the heat pump hot water heater. I think it's $600. So is it going to be $2,000? But it's 30%. Now I got lost on that one. Yeah, basically, I look it up every single time in every case. Now, for those people going and doing residential, for your clients, if they're doing geothermal or solar or putting in batteries that can store a certain amount of kilowatt hours, there are 30% credits for those, and those can be huge because we know geothermal is what, $30,000 these days. What are people paying on geothermal? Anyone know? I feel like that one of my neighbors is paying 100. Yeah. And I was like, are you kidding me? But that's 30%, and it doesn't seem to be limited to any dollar amount that I can find. So that's something good if you want to go down that route. Once again, in all of these cases, don't go doing things to your house to save money in taxes. Do the things on your house because you have to make those improvements to your house, and then if it saves you some money in taxes, fantastic. We don't want the tax tail wagging the financial dog. Make sense? All right, so we also have the electric vehicle credit. We've got a lot of clients in the last year or so who have taken advantage of this. There are some income and some price limits. I think if it's a sedan, it can't be more than $55,000. It's a SUV, I think it's $80,000. Now, if you purchase it as a business vehicle under your business, then there's no income limits. So that's something to think about. And you'll see a lot of vehicles these days, they're advertising these crazy leases for these electric vehicles. And what it is when you lease a vehicle, who owns the vehicle? The leasing company. They're a corporation. They don't have income limits. And so they're able to offer you a lower lease payment because they're able to take the $7,500 credit on the vehicle. So that's how that's working out. And they realize that with a lot of these vehicles, the people are going to be higher income. So from what I understand, and I haven't had time to research this, but you can also get around, if it's leasing, you can also get around the price limits on the vehicle. But I have not found anything to corroborate that yet. Credits taken on the return. Yeah, so currently for anybody who purchased them in 2023, the credits, you'll take them on your tax return. In 2024, there's going to be an option to have the credit taken right at the dealership, and they'll take your social security number, and you're going to have to attest that you are able to take this credit based on your income, and they'll have some questions, and so that's how that's going to work. It seems as though if you take a little bit more credit than you're entitled to, that the IRS doesn't have a mechanism, nor are they interested in clawing that back if you take it at the dealership. I'm not saying that you should, and and I'm not saying you should lie when you attest to it, but if you make a little bit more money than you thought, then, you know, it seems as though it's gonna be a no harm, no foul. This stuff is changing all the time. All right, let's get into it. Here's our current tax rates. And what I like to do is focus in this area, you know, it doesn't take much to get into that 22-24% bracket. So I just want you to take a quick look at those numbers for the federal tax bracket. So we all pay our federal taxes, and then what we have are state taxes as well. And you can see up in Maryland, we have some of the highest, and Virginia, people will always complain about personal property tax, but let me tell you, the personal property tax doesn't get you anywhere close to the Maryland. You know, people say, oh yeah, there's $60,000 on a Lamborghini. Well, that person makes $1 million or so. So, you know, it ends up or I think it was like $6,000 or $7,000 on a Lamborghini. But if you look at the Delta dollar earner, they were paying $30,000 more in taxes in Maryland. But so we've got our Maryland state tax as well, or our state tax, you folks, a lot of Virginia folks. And then we've got our self-employment tax. This is made up of two taxes. It's your Social Security tax and your Medicare tax. And they're actually not 7.65 and 7.65. It's like 12% and 3.9%. But as self-employed individuals, you have to pay both the employer portion and the employee portion. So that is 15.3% in tax. So if we add up all the taxes as a real estate professional that we have to pay, and you folks are going to be you know, about 2 or 3% lower here, but if you're in that 22% bracket, then you're paying 15.3% in Social Security tax and about 5% in state tax. So you're going to be at 42%. That you have to pay in taxes on any business income for which you don't have a business deduction. Now, a lot of times when people think of deductions, they think of their primary home. Now, not you folks, because you're realtors and you've been in the game for a while, but a lot of times people are thinking of their primary home or medical expenses or their retirement account contributions. And all of these are second-tier deductions for you folks. And the reason is that those deductions only save you on your federal and your state tax, but you still have to pay the Social Security tax. So with our realtor clients, with our self-employed clients, we always want to focus on the business deductions first, and then we'll worry about all the personal deductions, because those only save on 2 out of the 4 taxes.
Can I ask you a question?
Please.
On the SC, if Social Security is about 6 point something and for Medicare is about 4 point something.
I want to say it's like 3.9 and 12.4.
Yeah, I mean, that's
Yeah.
about right. So why is ours 15.3 higher than what those two are?
Oh goodness, you're gonna make me do math. Okay, no, it's so it's 3.9, 15.3 minus 3.9 is your Social Security tax. Does that make sense?
Well, I just did a W-2 for my housekeeper.
Right.
Right, it's not 15% that I pay for.
You pay 7.6. You pay 7.65.
I pay her side, both sides.
So you're paying. No,
Yeah, what?
because you pay, well, because you hire her, you're paying both sides, so you're paying actually the 15%.
Yeah,
Am I?
yeah, you're supposed to
And
be.
she deducts half. You deduct only half on your,
Okay.
you know, but the total of he's right is 15.
Actually, it's what, it's 2.9, it's 2.9 and it's 2.9 and 12. Yeah, that's what it is. It's 3.9 if you're at higher end, right? That's what I got mixed up. But yes, if you're paying both sides, it should be 15.3%. Yes, yeah.
But not on the W-2.
Yeah.
Thinking that W-2 is only what you just said on the W-2. But that expense that goes to your business and on your net income, you are paying the other, your piece of it. So if you're confused that I only, issue W-2 and I take 7.65 deduction, you're right. She, on the W-2 it is that.
Yeah. Okay, so in other words, you would be giving her back the 7.65 so that she, and you would be paying the 7.65 to the government, if that makes sense. It's not really the way, she's supposed to pay her portion, you're supposed to pay her, is the correct way to do it. So we don't want to give tax advice again. Why? Investment properties. Who wants to sell to a wealthy investor? Everybody, right? We don't want poor investors, okay? And so if your investor makes over $150,000, they're not allowed to take any of the losses on their rental property unless they have a rental property that's showing profit, and then they can only take them against that profit. But for the most part, no losses are allowed. Now, if they do have losses, it's actually kind of a good thing, because then we can hold those losses in abeyance. And when they go to sell the property later on down the road, they have a lower tax bill later on down the road. I could give almost a half-hour speech on just this, but there's also, now, as real estate professionals, there's an exception for you folks. If you own a rental property, you can get aggressive and say, look, I'm a real estate professional and I want to take these losses the year in which they occur. You're allowed to do that. There are some rules that you have to follow. And for also people who have rental properties that where the average rental is under 7 days, you can get aggressive and you can do that. There's some pitfalls to doing it. And I don't want to get into all that, but I just need you to be aware that these rules do apply. But oftentimes with your wealthier investors, they're not going to be able to take a lot of those losses on the rental property. You have to think of investment properties for the most part as a way to build wealth, with somebody else's money, not as a way to save money in taxes. It's a tax favored strategy to build wealth. That's it. It's not really typically a way to save money in taxes. Does that make sense? Okay. Great. I'm gonna. Okay. I love to see. My mother loves this slide. I hate it because it brings up too many questions. And but the $25 rule, it is just to say that, and nobody uses much cash anymore, so I'm not going to belabor the point on that. But the $25 rule speaks to if you are giving gifts to your client, and let's not spend a lot of time on this, but if you're giving gifts to your client, you're only allowed to deduct $25 per married couple per year. That's nothing, right? So as realtors, you folks are all expected to give something nice, give some gifts. And so if you can do it in a way that we can call it marketing, we are happy to do that. But it has to be something reasonable. My favorite scenario, nobody seems to take, but there was a realtor, this scenario came from a realtor who actually used to do this. But she would bring a big Rubbermaid trash can to settlement with her name stenciled on the trash can. And this way, what would have been a gift is now a marketing expense. Okay? Because why? It's going out to the curb, and other people, not the client, are going to see her name and information on that trash can once or twice a week, depending on the neighborhood, right? And then what's the question I always get right after that? What if I give out champagne bottles with my name? Good God, who's gonna see that, you know? If the champagne bottle is $30, you know, fine. But if you're spending $150 on champagne bottle, a piece on champagne bottle, it doesn't work. And then the next question I get is, what if it's scotch? Okay, no, this doesn't work. We need something a bit more permanent. We want something that that other people are going to see. So think about it. Really, what I like, if I was back doing real estate again, what I would really focus on is think out of my commission that and the client knows that, hey, I've purchased a warranty for them, or I've done this, and then we can call it a client accommodation instead of a gift. No limit. No, I'm not going to push that. It'll be the first time ever. Okay.
What if we pay the junk fee, the admin fee for a client?
Love it, because that was something you did to get to settlement, right?
So we can write all that.
We'll call it a client. Huh?
Sorry, I mean, to add anything.
But you get it.
We can write it all off. 100%.
I mean, provided you paid it
Yeah. I got it.
out of your commission. Yeah, absolutely. Absolutely. Okay.
I think the transaction fee just went up $100.
Exactly. I mean, but, oh goodness, I mean, I can't believe you guys aren't fighting me on this one, because it's like, but I buy cases of wine. Great, you buy cases of wine. And it's $1,000 a case, and there's 12 in there. I can take 12 times $25. And that's all I can write off on your $1,200. Okay, deductible expenses of the primary home. Now, with our primary residence, and for your clients, they can write off the interest paid on the principal up to $750,000. They can have up to 2 houses, but in average, you can't write off more than 700, the interest on more than $750,000. Then now, of course, that was a bummer a few years ago when everyone was getting 2 or 3%, but now that interest rates are 5%, that's actually going to start to factor in and be a little bit bigger deduction for people. Now we have our real estate taxes, but you may have heard of the SALT limits, which came into effect in 2018, whereas you can only write off state and local taxes $10,000 per year. So you folks pay state income tax. You folks pay here. You're going to pay the personal property tax, and so a lot of times once those taxes are paid, we're not really writing off much in real estate taxes at the end of the day because we're already well past the $10,000 limit. These do expire in 2025, but there's going to be a lot of tax law changes in the next year and a half or so because all of the tax cuts, just about everything is supposed to expire. So it's going to be a mess in the next couple of years here. Now, so the interest, the real estate taxes, for most people, it's only going to save them on 2 of the 4 taxes we mentioned. As self-employed individuals, we can do something a little different, and we make sure we have that office and home. And so, besides just the interest, so we can go above that $10,000 limit now, and we're writing off some of the expenses against 4 taxes now. We can take actually, I'll do it on the next slide. So office and home, almost every single one of you at this point is taking your office and home. About in 2016, IRS came out with a little change, and they said, not only is office and home not a red flag, it hasn't been a red flag since 1999. But we're going to give you a simplified method to do it. And so we're going to make it real easy for you. Don't worry about filling out the office and homes worksheet. You can go ahead and we'll do it on the front side of the Schedule C, easy calculation. If IRS is making something easy for you, are they saving you money in taxes? Do I get nice things like that? No, absolutely not. Absolutely not. Now, they are not, it's not saving you much money in taxes. It's better to do the correct method, which is on the 8829 form. And for those of you at home, if you want to take notes, this is the only note you should take. Make sure your tax return has the 8829 form, and then you know your accountant is at least doing their job on your office and home and doing it properly, as opposed to taking the simplified method. So a lot of accountants do the simplified method. It's much easier. But it's not going to save you more in taxes. You just need to have an area that's regularly and exclusively. It is not your dining room table that you also have dinner on. Okay, it can be your dining room table if all you use is your dining room for your office and nothing else. Great, we can take the dining room. But you don't need to own a home. You don't need to meet any of your clients at home. We just go ahead and we take let's say your office and home is 10% of your home. We can take 10% of all of these expenses, your mortgage interest, your real estate taxes, your insurance, your cleaning services, repairs, utilities, HOA condo fees, your rent, if you're renting, whatever. We can take that and deduct it against all 4 taxes. As opposed to before, we were only allowed to take the mortgage interest and the real estate taxes against 2 of the taxes. So, great. what does that mean? It usually means $1,000 to $3,000 in tax savings for doing this correctly on the tax return. And that's just for the office and home portion. Okay, now, because we have an office and home, we rarely have any commuting miles anymore. Because in the morning, what's the first thing you folks do? Unfortunately, if you're anything like me, and I know you folks are, the first thing you do is go down to your home office and check your email, right? And then you go from your home office to go to a client showing or go to the office, whatever. But you are now going from a business location to another business location. Without the home office, we are leaving our house and we're going to a business location, which is commuting. Commuting is not deductible whatsoever. Okay, so if you have, so for realtors, one of your largest line item expenses each year, if it's done properly, is oftentimes your vehicle expense. Okay, so if you have large vehicle expenses, high percentage of vehicle use, and you don't have an office and home, it doesn't make sense. Unless you keep a car at the office, which nobody does, almost nobody does. Plumbers do, mechanics, they'll keep a van at an office, but realtors don't keep a car at the office that they use exclusively. You leave from your home each day. So if you have 80, it's hard to justify anything more than 50% business use on a vehicle if you don't have that home office. I'm not going to belabor the point because 10 years ago, nobody was taking home office and they thought it was a red flag unless they were our client. We've been telling them for 15 years prior to that, it isn't. And we have 2,000 realtor clients. So please take our advice.
Just to clarify, you cannot write off your miles between your house and your next office if you have a home office.
If you do have a home office,
Right, but if you can find it somewhere
right.
within each client at the office.
If you're leaving your house, which is a business location,
Right.
okay, and going to anything that has to do with business,
Show the house.
absolutely,
Going to the next office, going.
that is business mileage.
Right.
Okay, if you don't have the home office, the first trip of the day and the last trip of the day is commuting. Does that make sense? Okay, and same goes for the last trip of the day when you're coming home. We all come home and we want to relax, and what's the first thing we do? Let me check my email. So we come home to our home office, check our email, make sure everything's good. Okay, now I'll go deal with the kids or go deal with my hot water heater that's not working or whatever. Okay, and so we've gone, our first and last trip of the day are business miles, where if we didn't have the home office, it wouldn't be. All right, great. So, let's see here. Don't forget about that. And, okay, another question, I haven't gotten this much recently, which is funny, but for the most part, people will ask me, about standard, whether they should take the standard mileage rate or actual vehicle expenses. 98% of the time, it is going to be more advantageous to take actual expenses. In both cases, you have to track your mileage because we have to know the percentage of business use for the vehicle. So in all cases, you got to track your mileage with, use one of these mileage apps or whatever, or you have to be able to recreate it from a calendar or something like that. But for most realtors, it's going to be more advantageous to take actual expenses. The exception is, well, they raised the standard mileage rate significantly the last couple of years, but usually a realtor who does a lot of driving and has an old vehicle that is reliable, they would probably be a better candidate for standard mileage rate. But that's not my clients here. That's my clients in West Virginia or in Frederick or out in Winchester. Those clients typically have a vehicle that they use. They do a lot of driving and they use something that's relatively reliable, that they're not going bankrupt trying to drive around all God's creation.
So just to clarify,
Mhm.
if we do a lot of local work and we have a lot of miles locally, not really long distance miles, but we have an expensive car, whether it's an old car getting a lot of repairs or a fancy new car. If you have high car expenses,
That's a perfect candidate for actual miles.
actually,
Yeah, for that, I mean, for the actual expense method. Okay, and so that is, like I said, it's probably 98% of our clients. We do both calculations. And 98% of the time, actual is going to be better than standard mileage rate. Yeah, yeah. Oh, all of the 2% are our clients who live further outwards.
and to do
Just about.
actual, we have to have one dedicated automobile.
No, No, just the business use has to be more than 50%. That's an excellent question, because I should have said that. To do actual expenses, the business use of that vehicle has to be more than 50%. Most of our realtors are gonna be somewhere between 65% and 85% business use on their vehicles, especially the ones who are here around town. The last thing realtors want to do is drive all around when they're not oftentimes. That makes sense? Okay. S Corp, I'm not going to get into this too, yeah.
Can I ask a quick question?
Sure.
If the business use is less than 50%, you can still use the standard mileage?
Then we have to use the standard mileage rate, or we have to do straight line depreciation, but it's gonna be better off to go ahead and do the standard mileage rate in that case. Okay, the only thing I really want to say about S Corps is that most accountants will push their client into an S Corp way before they're ready to do so. And there are tax savings for being an S Corp, but really your net income has to be above $180,000 to make it even, to really break even. And so really, when our clients, their net income, after all expenses, when it's above 180, we'll say, hey, look, if you continue to perform this way, then we should talk about converting you to an S Corp. But there's also a big pain in the butt factor. You're filing 4 tax returns a year as opposed to 2 typically. So and the expenses go way up. So what we don't want, and a reason a lot of accountants love to push their clients into S Corp is, look, our fee goes from $1,000, $1,500 a year to $4,000 a year. Plus, you've got to pay the payroll company, and you've got to get QuickBooks, and you've got to get somebody doing all your bookkeeping. So you're going to pay $10,000 more in accounting fees a year. Well, those tax savings better be there to outweigh not only the pain in the butt factor, but also all the fees that have to be charged to keep this entity in compliance. So, accountants love to push people into them, but we close more S Corps that were opened by other accountants than we open. People get into them far too early and then are getting, letters from the IRS for 4 years. And so you just want to be careful before you do it. If your net income is above 200K, so usually gross income is going to be close to $400,000 of real estate income, then you're a really good candidate for having that S Corp talk. All right, medical reimbursement plan. So Marty retired this year, but he is still doing the medical reimbursement plan. Marty in our office, he does the second most of these in the country. I'm not going to talk too much about these because I only have a few minutes left, and I really want to talk about beneficial ownership information. If you have children and you have a lot of medical expenses that are not reimbursed, then it may be a good idea to hire your spouse and you put your spouse on payroll, and then you can reimburse them for their medical. Yeah, somebody have a question? Oh, okay. Great. So you can reimburse them. This has been around for over 100 years. It was actually made for farmers, and it was so that they could hire their spouse and go ahead and reimburse them for medical expenses. So you definitely. Yeah, that's from a while back. All right, great. And let's see here. So Marty in our office, he does the second most of these in the country. He has retired at year, but he is still working on these for clients. The 401k plan. Okay, so if you have a retirement account as a real estate professional, it should be a solo 401k. And the real reason for that is that it gives you the most liability protection more than your SEP IRA, because it's a qualified plan. And if you don't believe me, ask OJ Simpson, who is on the golf course every single day, even though those of us who are old enough, and just about all of us are, to remember that he lost a civil case and lost all of his money back in the 90s. But he's still in Florida playing every single day. Why? Because he had a 401k with the NFL. And that's it. That money cannot be taken away from you. Change your 401k. But that's not even the best reason. That's a great reason. Another reason is you can put more money in the solo 401k than any of the other plans. Okay, fine. Still not sold. Well, with the solo 401k, you can take out a loan from your 401k. You cannot do this with a SEP. You cannot do this with an IRA. You can take a loan out from your 401k for any reason, and you pay yourself with interest. You can take out to $50,000, I believe, or half of the balance, whichever's less, the amount in the account. But you pay yourself back. Now, if you take that money out of an IRA, let's say it's $10,000, you've got $20,000 federal tax, you've got $800 in state tax, $1,000 penalty for taking it out early, because none of us are old enough to be taking money out of our 401k. And so you are going to owe $4,200 in taxes if you take that money out of your IRA. Now, you take it out of you take a loan from your 401k. You do have to pay it back, but you've got that $10,000 to work with. And so this is not a great way to get money, but it is a release valve in case you have an emergency. I have 2 rental properties that I did not have enough cash to purchase had I not done this. And now I've got good amount of equity in 2 properties that I otherwise could not have afforded to purchase with the amount of cash that I had on hand had I not been able to take advantage of this. So it's that you should have in your toolkit, because as realtors, I think you are in the best place of anyone to be purchasing investment properties, because you know stuff about stuff before it gets to market. You know what's a good deal and what's not a good deal. And so it's just another tool in your toolkit. Let's see here. Instead of Q&A, I'm going to go over beneficial ownership information. And so this is the Financial Crimes Reporting Unit. I think this came under the Inflation Reduction Act last year. It was actually a bipartisan measure, though. So both wanted this. If you have a company, you have to log in to the FIN website, and you have to report yourself as the owner and upload a copy of your driver's license. And I did it for myself about a week ago. It wasn't very hard, but the government needs the language used is kind of confusing. I had to put in my name, address, my driver's license. I had to do that twice. One as the person who's reporting, and then the other as the owns the corporation. Correctly? No, I don't know. But the penalty for non-compliance is $500 per day if you don't do this. Does everyone hear me? If you have a company, you need to look into this. You can go on my website and I send out a newsletter about this. But if you go ahead, you do need to look into this. You do need to either consult an attorney or try and figure this out yourself. But regardless, it is the penalty is outrageous. Beneficial ownership information.
Yeah, you have that one.
if you have an LLC or a partnership or an S corp, if you own any type of entity, you look and comply with this, because, like I said, the penalties are absolutely outrageous. And one of the questions that I got, a bunch of people emailed me yesterday and said, oh, I have a sole member LLC. So I read the law and it says that sole proprietors don't have to do this. I have a sole member LLC and it says sole proprietors have to do. A sole member LLC is not a sole proprietor. Read it again. Because it specifically says sole member LLCs have to comply with this. And so most of our have a sole member LLC but once again, this is all legal advice. I'm not allowed to the attorneys love this right now because they get to charge $300 to put that person's name, address, and a picture of their driver's license in our website. 3 minutes. The attorneys are loving, and they are threatening to sue accountants for practicing law without a license. And even though it says accountants can do this right on the government website, but then we're talking to our insurance companies and they're like, the penalties are so high, we'll not insure you for doing it. So
Only sole proprietors are exempt.
only, I'm not saying anybody's exempt. I'm not giving any advice on this. Everybody has to read those, but I'll tell you who's not exempt. Sole member LLCs are not exempt. All right. Any questions?
Yeah.
Okay, anticipation first, and then, so if you, from what I understand, I'm not giving advice here. But, oh God, I'm so nervous about giving advice on this because they're freaking out about it. But look, if your company was open before January 1st, you have to do it by the end of this year. Okay, if your company is open, it was open after January 1st of this year, as I read it, you have to comply within 90 days. I don't think that that's too spicy. I just really don't love giving advice on this.
Is this for any business owner or just real estate?
No, it's for any business owner. Yeah, and so what they're trying to do is make sure that people aren't money laundering. And you know who's exempt? Big corporations. Any big corporation doesn't have to do this at all. Just like, so it's always us little guys who have more compliance to do than really should be necessary. But
So we're thinking to investors who are setting up LLCs to buy different properties. Each one of their little LLCs probably needs this.
that's a great question. Each LLC has to do it. So me, I have ownership in 4 LLCs. So I've got to I have to fill this out 4 times. And so I did the first 2 because I knew they would be the easiest already.
Silly question.
No,
I have an LLC. I don't own anything.
still have to comply. Yeah, like I said, it'll only take you 2 minutes to comply with the government.
Where do you go on to comply?
You go to the FinCEN's website, just look up beneficial ownership information report. BOIR. If you just Google BOI, it'll take you there, and the report, then it's called the report, so it's a BOIR. Yeah.
So this is the first year you have to do.
This is the first year. Yeah.
Yeah,
Yeah.
you guys are not to create a touch point with your potential clients. You don't have, I have a few LLCs, so I imagine going in there and burning a new skill that otherwise has a daily penalty of $500 a day would be nice to reach out to your clients. And not an attorney, but read the tax code here. If anyone needs any, help navigating the website, I've done it. I'd be happy to. And I think for a lot of investors, tremendous amount of people, LLCs will, things like that, I imagine. Just a good way of saying,
Yeah,
and kind of like, throwing a Super Bowl party a year in advance. You could hit that touch point every quarter and it still would be relevant, especially now through the end.
yeah, I agree, that would be a good strategy. What else I would do, or in lieu of saying, I can help you with it, I would say, here's an attorney I know who may be able to help you. What I said was, I did it and it seemed pretty easy, that's what I said in the newsletter, but,
Yeah.
but consult an attorney, I can't give advice.
No, that's beautiful. I did it, and I didn't have problems with it, but a consultant, if you need, a consultant attorney, I have some referrals for you. And if they call you offline, the conversation never happened.
Our LLC attorney who set up our LLC just emailed this on Friday and said, FYI, go through this checklist, figure out if you have to file, call me if you have questions, and just sort of.
Yeah, I don't even think a lot of attorneys, like my sister is an attorney, I don't think a lot of attorneys even wanted, even though they can charge $200, I think the liability is so big that they kind of don't even want to touch this. And it's so easy to do it, give the government what they need. The robots can come find us later, I don't know, but.
Is that something you found once, or maybe you're?
So as I understand it, it's a one-time filing. But if any information that you've put in there changes, you have a unreasonably short amount of time to go out and go ahead and update that information. You have it. If your address changes or whatever, or your name change, or if anything that you've reported changes, you have a short time in which you need to get back on there and report it to them.
That's just a one time per LLC exercise. It's not every year.
Correct. Something changes on the, with the LLC.
So if the operating agreement, the cap table changes, and you have new owners, then you have to update that.
Yeah, if there's new owners, and I think, well, there are certain minimum percentages of who needs support as an owner. So that, but, yeah, that's a great question. As I understand, if the owners, if there's a change in ownership as well, you better make sure you update that. Any questions from people in the game?
I have a question about your services.
Yeah.
So it's a good time for us to consider new CPA, because our hiring to somebody else, and our bookkeeper just upped her fees. So tell us what bookkeeping you provide, what CPA stuff, like how we would think about moving over to you.
I got you. Yeah, now is a great time to come over to us or over the summer, because right now we're busy, but we're not too busy to bring somebody into the fold, and we can manage those expectations. If you're well organized, great, we can get you done by April 15th, no problem. If as bookkeeping is concerned, we are looking to offer in-house bookkeeping. Most of our clients who are not S corps don't need. We can advise them on a way to manage their books themselves that is relatively easy. We do have bookkeepers that we refer out to. We don't love any one of them at this point. So even though we've been in business for 54 years, it's like, yeah, I guess we're going to have to probably offer some bookkeeping services, because we are getting many more S corps than we had in the past, and so S corps do need bookkeeping, partnerships do need bookkeeping, C corps do need bookkeeping, and we've got about 200 entities, and now we're at the point where it's like, we can't just keep referring these out and be in love with the end product that we're getting. we'll probably be offering bookkeeping by middle of this year. But as far as our services go, most realtors, the price starts between $1,000 and $1,500. Rental properties, other states, things like that, those are additional fees. If you have foreign bank accounts, that's additional fees as well. But you know, most of our clients are going to be between $1,000 and $1,500.
For a tax return.
Yeah.
So like for us, we've got my family's tax, and Jeff's family, and our LLC, which we work together.
And so that LLC is a partnership then? Okay, so the partnership would be significantly more expensive. Our partnership returns start around $3,500 per year. And we do need to make sure that there is proper bookkeeping for that. And and then each individual's tax return would be about $1,000 to $1,500 typically, unless there's a bunch of rental properties or something in there. And yes, a lot of accountants are dying or retiring right now. That's where almost every phone call I get is my accountant just retired. So for the longest time, and you know, there's been articles in the Wall Street Journal about no kids are going into accounting, but I've been able to bring some new folks into the fold here, and so we do have capacity, but we're going slow. I want to make sure that the product we deliver to clients is exactly what I expect at the end of the day. And that's why I've got my people here as well. So that there is no disconnect between what I'm telling you and what I'm delivering at the end of the day. Any other questions?
No, sir.
Check the chat.
But the chat. Somebody corrected me on 2.9%. I saw that. What else we got? Okay. There we go. Real estate professional status question. I'm a real estate agent, own my own LLC, which is taxes and S corp. Receive W-2 wages. Excellent. So you're doing something right. Own a rental real estate with other people through an LLC. Tax as a partnership. I receive K-1, which okay. Since I'm a real estate agent, more than 750 hours of my time is dedicated to real estate. Can I apply to be the real estate professional instead? And deduct those losses from my taxable income. Okay, so for the chat, I would love to really talk about the entire situation, but there's a distinct possibility we can make the argument that you are a real estate professional. You have to be doing real estate more than anything else also. So we would really like to take a look at the whole situation before addressing that. And really the question is, do we want to get as aggressive and take those real estate losses in the year in which they occur, because we are going to be knocking the basis on those properties down significantly. So we'll be saving a few $1,000s each year. Sometimes it's more than a few $1,000s, but we'll be saving a few $1,000s each year. And if the end game is to purchase that property and sell it later on to put the kids through college or, you know, to retire on, if the end game is that, well, we don't want a huge tax bill later on down the road. Okay, if the end game is I'm going to 1031 exchange this thing until the wheels fall off and I'm going to die and my kids are going to inherit it, great. Let's burn it down. You know, let's depreciate it down to nothing because the kids will get a stepped up basis when you die. But this is all generalities. I need to look at the entire situation to really answer the question properly. Anybody else at home? Feel free to just turn off your microphone and chime in. All right. I'm happy to, you know, we're happy to hang out, answer questions, you know, talk. You know, I'm really good at talking about barbecue, hunting, sailing, scuba diving. So I'd rather talk about anyone, but I'll answer questions too.
Thank you, Preston.
And thank you guys for having me. We really love, you know, talking with you guys. You have me every single year, you know. Less and less do I get, where's your mother?
Brother Linda?
What? You know, you didn't know Linda? Yeah.
No, she's used to present to our office.
Exactly. So she'd go out and give these speeches and I'd have to do all the background. I'm like, look, I love presenting. You just stay home, help me out with my kids once in a while. I'll do all the speeches, please. It's much less work for me and gets me out of the office. So that's what I appreciate most is you got me out of the office. I get to try a new pastry shop down the road.
Nice.
Oh, but that line was outrageous. Guys at home, see you, just email me, look at my website. If you are interested in becoming a client, you can just check out my website and click on the new client tab and book an appointment with me. I'm happy to speak to anybody. If you can't tell, I love the sound of my own voice, so.
Thank you.
All right, have a good one.
You too, thanks.
Bye-bye.